Bill Nygren joins us, Oakmark Funds CIO, USM Portfolio Manager, joins us today. Hey, Bill, good to see you.
Thanks for having me, Carl.
Dive into that, this mega cap growth fund idea. What leads you to that, and what parts of the market reflect it?
Well, when we look at the Oakmark Fund and we think about it as a place that an investor could put money and not think much about it for the next 5 or 10 years, the S&P 500 has always been that kind of index where someone could put the majority of their capital, believe it was reasonably well diversified, and not think about it very long. But there are 4 or 5 names now in the S&P 500 that have a larger weighting than our largest position in Oakmark. The technology sector is becoming dominant within the index, and the 25 or so largest names in the S&P 500 make up about half of the investment. So it's not nearly as diversified as investors think it is. And I think we'll see investors revisit the idea of the S&P 500 being kind of the low-risk way to invest in equities.
And what do you think would take its place?
Well, I think just a more diversified portfolio. There's no reason to think that an individual is best off by having their personal investments match what the economic production is or what the market valuation of that production is. If you think about someone who lived in South Africa, I mean, there'd be no reason that they would want their whole portfolio to be gold mining and minerals. The U.S. economy has been pretty well diversified for a long time, but today, the way the market is valuing the technology sector, an S&P 500 investment is really a pretty heavy bet on tech.
Yeah, but Bill, can you blame them? I mean, what is it, 93% of active managers have underperformed the S&P over the last 20 years? I mean, why would I want to go with you when I can just go with an index?
Well, our 20-year number is not bad, and since inception, we've roughly doubled the performance of the S&P 500. But the reason is because we follow a thoughtful process of investing in out-of-favor companies, and there aren't many of us that do that anymore. It's gotten to the point that some academics think there aren't enough value investors to force convergence to fair value anymore. And that's why it's become so important to us that we invest with companies that are taking matters into their own hands and using excess capital to repurchase their own stock.
Yeah, but you're raising an important question. It's one that, again, I'll reference Mark Rowan from an interview we did last week about the public markets themselves. I mean, you seem to be indicating, I don't want to use words, but, is there a crisis here because of the lack of price discovery and or at least the lack of people like you who are actually doing that?
Well, I think there is an issue with how many investors today want positive price momentum in their portfolios. They don't like to buy companies that have fallen to a cheap price. They want to buy after they've gone up somewhat. But I wouldn't call it a crisis at all. I think it just creates a tremendous opportunity for companies that are good businesses, generating a lot of cash flow, and it gives them the opportunity to increase per share value by reinvesting in themselves.